With us is our financial planner, CFP Harrison Johnson, talking about what is net investment income tax. Would you stop finding all these taxes people are paying?
It's a lot of taxes out there, so it makes it complicated. But the net investment income tax, it's a federal tax. It is 3.8% on potential investment income that you have. So it started in 2013. It was a part of the Affordable Care Act, that bill, as a way to pay for it. But it's a 3.8% net investment income tax. It applies if you are a single tax filer and if your income is over $200,000, or if you're married, filing jointly, then it applies if your income is over $250,000. And one thing I wanted to point out is that, again, this was put into play in 2013, but that $200,000 and $250,000 limits, or the thresholds where it starts to apply, those have not been indexed for inflation. So more and more people are being subject to that. Like a lot of things with the tax code, a lot of things are not indexed for inflation. So if your income is above that, then if you have income from interest, dividends, capital gains, rental income, passive business income, annuity income, those are considered investment sources. So to the extent that your income is above those thresholds, those income sources, in addition to being taxed on the federal and the state side, you also have this net investment income tax that kicks on.
And is this on top of, can also include, because you got the Medicare tax too.
Yeah, the Medicare, which is another basically federal tax on your income. So as your income gets higher, federal, state, Medicare, IRMA is what it's called. And then this is the net investment income tax that
3.8%.
3.8% on, whatever your income is above those thresholds.
And I realized too, when you're talking, married couples get it in the shorts, because you said $200,000 for a single, $250,000 for a married couple.
Yeah. Yeah.
Well, usually it doubles.
Usually it's double. Yeah. So I don't know why that delta is so slim, but single people up to 200, married, only up to 250 is the room that you can avoid it. So once your income goes above that, you start to trigger it.
It makes it very difficult because, our saying is we'll never make a tax decision or economic decision. But gosh, it gets so difficult because you got 3.8%, the Medicare tax, federal tax, state tax. It's really difficult to deal with all these taxes.
I mean, you're talking about, 23.8% on the federal level if you're in that top bracket, plus then your state in California. I mean, if you sell something and have a capital gain, I mean, what does that put you at, over 40% on taxes?
In some cases. And that's the important thing is, you're talking about the capital gain taxes. So that's assuming that it's long-term capital gain or qualified dividends are taxed at that 0, 15, or 20% rate plus the 3.8. But if you have other sources like the rental income, or if you have interest from bonds or things like that, savings account, CDs, that's interest at ordinary income rates. So you could be at, 22, 24, 32, 35, 37% plus this 3.8 plus IRMA plus the state taxes.
Now, how do you, as a financial planner, I mean, and again, I just said that we never make a tax decision over economic decision, but how do you as a financial planner help clients with this?
Well, part of it is understanding that, if you have income that is going to be realized, like a lot of times this comes into play if someone's going to sell a stock, realize a capital gain. Okay, depending on how much you sell, you might also trigger this net investment income tax. Part of the equation is understanding, well, if you don't sell that stock now, how much risk are you carrying by continuing to hold it? And even if you do continue to hold it, is there going to be a way where you could potentially avoid that 3.8% tax in the future? So in other words, if your income is $400,000 and it's always going to be $400,000, well, you're really not ever going to be able to avoid this other than just by never selling anything, which isn't, probably a good strategy. So if there's a way that you can say, well, let's fill up this threshold or fill up the room that you have under that threshold as much as we can, and then maybe we'll put off some of it until next year to avoid it. Sometimes that makes sense. With that, you only are taxed at the rate that your income is above that. So if your income is like $240 and then you have an extra $20,000 of room, so that now you're up to $260, only the amount that's above that $250 would be subject to it. So sometimes, again, you want to do a little bit now, a little bit later. If your income is going to be changing year to year, that depends how much room you have that you want to fill up. But again, you also have the IRMA to worry about, which there's a lot of IRMA brackets and federal brackets and everything. So,
and I'm kind of cheating here. I'm looking at your notes, but
my notes are his notes.
His notes. But this kind of goes back to our conversation earlier about 401ks. I mean, looking at the taxation of capital gains, interest, dividends, all the rental income, as you said, you don't get any of that tax liability if you have Roth or pre-tax contributions. because that avoids, I believe, the 3.8%, correct?
Yeah. So, well, any withdrawals that you have from those sources are not considered investment income. So pension income, IRA income, Social Security income, wages, that stuff is not considered investment income. So that's just subject to federal, state, could trigger IRMA, but not this 3.8% tax. However, if you have a situation where you have some investment income and you're under the threshold, but then you withdraw a little bit too much from an IRA, that could increase your income and then push your investment income above that threshold.
Yeah, I just think it really is, again, so important for people to understand the taxation of, capital gains, dividends, interest, because it really, I think, pushes you down the point of why you should be maxing out your 401k, why you should be maxing out your Roth IRA, because it really reduces the concern of taxation that you might have to worry about down the road.
It gives you more flexibility too, because with an IRA or Roth IRA or whatever it is, you can control how much you're withdrawing. With investment income, if you receive interest, it's taxable. If you receive a dividend, it's taxable. If you own a mutual fund and it distributes capital gain income to you, it's taxable. So when you have more money in retirement accounts, you can choose how much you want to withdraw from which sources, so you can get more control there. And when I'm presenting a plan to somebody, the first thing that I go through with everybody is an overview on how taxes work. How are these different income sources taxed? How can we structure that? What different tax rates are there? Because ultimately, when you're making financial decisions, if you understand how that game is played, then that can show you what types of assets you want to build and then how you can access those in some income sources to create cash flow.
Yeah, and this is one thing that I believe we do it right, because Chase and we manage a $700 million portfolio. You're the financial planner. And when people come to us, a lot of times you go to somebody, I'm a financial planner, and they do the portfolio. You cannot do both. And you keep proving it week after week that there's so many things you look at, because you don't have time to do the investments, because there's all these other things you look at as a financial planner that people are not getting by going to your basic CFP financial planner.
Yeah, I just spent 3.5 hours presenting a plan to somebody, and it's not talking about the investing side, it's talking about everything else: taxes, Social Security, retirement, Medicare, debt, all of that stuff. So there's a whole lot that goes into it, as opposed to, what's your rate of return of your portfolio.
Well, that's why you're in high demand. Harrison, thank you very much.
All right, thanks, guys.
All right, have a good one.